So yes, this is a Your Stock Our Take. This came in from Mario via email. We actually got a lot of these questions on ADF Group. But Mario says, "Good afternoon. It is always a pleasure to listen to your podcast on my commute home." Thank you for that. And he says, "My question is on the small cap DRX. I bought a substantial amount in 2022 and became about 20% of my portfolio as of the beginning of 2024. Then the price went down, but I couldn't find any major reason for it and bought more at the end of 2024. I believe in holding stocks for the long run and let the winners go. It continues to lose momentum so far. I would appreciate your opinion." So here is my opinion here for you, Mario. So again, this is ADF Group Inc. or DRX on the TSX, currently trading at a price of about $8.90 with about $160 million market cap and about a 0.4% dividend yield. So ADF Group is a North American leader in the design and engineering of connections, fabrication, including the application of industrial coatings and installation of complex steel structures for the non-residential infrastructure sector. And as of Q3 2025, management noted that its Canadian facility in Montreal is at about 70 to 75% of capacity, and its US facility in Great Falls is at about 65 to 70% capacity. And the fabrication shop in Canada can do approximately 100 to 120 tons per year, while the US fabrication shop produces approximately 25 to 35 tons per year. So most of the fabrication tonnage is coming from Canada. So the stock has had a strong run since the beginning of 2023, up about 330%, driven by strong financial results. And as Mario indicated, the stock has since become a large weighting in his portfolio due to the gains. So, I will say congrats on the gains there, Mario. Now, the last time we covered the stock on the podcast was in October of 2024. Brett covered the stock on the podcast at that time, and really I'm going to be parroting a lot of what he said then. But we also actually wrote up a monitor report for clients in our most recent Canadian cash-rich profitable small cap research report released in late December. Now, looking at the recent quarter of Q3 2025 ended October 31st of 2024, revenue was down about 3% to 80 million from 82.1 million in Q3 of 2024. Gross margin for Q3 of 2025 was 30.4% compared to 24.4% for the same period in 2024. Now, the improvement in margins is largely attributable to a better absorption of fixed costs in line with the increase in fabrication volume, the continued favorable impact of the investments in automation at ADF's plant in Canada. So they have been making automation investments there, and a favorable mix of projects. In fact, since the beginning of the current fiscal year, the mix of products in fabrication was particularly favorable given the increase in automated fabrication, which is higher margin. Now, adjusted EBITDA was 24 million or 30% margin, up 35% from the same period in 2024. And net income rose to 16.4 million or about 55 cents per share, up 47% from a gain of 11.2 million or 34 cents per share for the same period last year. And the balance sheet is in a net cash position of about 19.1 million. And this equates to a net cash per share balance of approximately 64 cents per share. So let's look a little longer term at how the business has performed. So year to date, we have seen record margins with gross margin of 32% and net margin of 18%. But keep in mind, ADF Group is a contract-driven business. And over the long run, margins have been cyclical, which management equates the recent margin expansion to about a third coming from the automation investments coming online at its Canadian facility, about a third absorption of fixed costs given the higher volume, and as well last year, about a third from project pricing benefits. So margins are certainly at a historical high right now compared to the past decade. Now, ADF Group's order backlog totaled about 330 million, compared with 339 million on the same date a year earlier, and about 510.9 million on January 31st of 2024. Now, on average, management says that backlog is comprised of about 45 to 50% of fabrication hours, 35 to 40% for installation, and the balance is for raw materials about 10 to 20%. And the reason I'm bringing this up is just to show that the backlog is not super sensitive to the price of steel. Now, the company does not provide guidance, but it is of management's opinion that they still see 3 to 4 years left of growth in what they're claiming an atypical business cycle. They also voiced that margins were heightened in fiscal year 2025 and will likely come down in fiscal year 2026. Now, growth in revenue is anticipated, but gross margin dollars are expected to remain flat year over year, given the margin or gross margin headwinds. Now, since the company became profitable in fiscal year of 2021, you can see on the graph here that I have up on the screen or the table, the company has maintained an average price to earnings multiple of approximately 6 times. And now looking at the current trailing valuations, ADF is trading at about 4.6 times trailing accounting earnings, which, like I just noted, is below its 5-year average of 6 times. And the company trades with an enterprise value to EBITDA multiple of about 2.8 times and a price to cash flow multiple of about 3.1 times. So, relatively speaking, the company looks cheap, or at least appears cheap. And here, I just essentially wanted to show this up on the screen, or tease that, for clients, I actually went through a scenario for fiscal year 2026. So I actually hypothesized an expected growth rate in revenue and a net income margin to provide clients with what we believe fair value to be if the stock can continue to trade at its average PE multiple of 6 times. But obviously, this is exclusive to clients in that report, which was released in December. So to conclude on ADF Group here, ADF Group has performed well over the past 5 years, growing backlog to $330 million in fiscal year 2025 from about $200 million in fiscal year 2019. And it also expanded gross and net margins from about 8% and negative 0.5% respectively to about 24% and 11% in fiscal year 2024. Now, over fiscal year 2025, the year-to-date period, gross and net margins have expanded even further to 32% and 18% respectively, driven by better absorption of fixed costs, and of course, increase in fabrication volume, the continued favorable impact of investments in automation at ADF's plant in Canada, and again, favorable mix of projects given the increase in automated fabrication at its Canadian facility, which is higher margin. Now, cyclically, ADF is exposed to the non-residential construction industry with a typical business cycle lasting, 5 to 6 years, followed by a couple years of slowdown. And during an upcycle, ADF's margins have typically performed well. Now, management indicates strength in demand persists with further upside to the current cycle, driven by infrastructure spending in the U.S., lower interest rates, and reshoring of manufacturing. But looking forward to fiscal year 2026, margins are expected to come down given the favorable factors experienced in fiscal year 2025. And on top of the cyclical risk, a majority of ADF's revenue comes from the US. This is actually above 85%. Therefore, US and Canadian trade relations, such as tariffs imposed on Canadian goods, can impact the company's demand and profit margins, with, of course, President-elect Trump threatening, a 25% tariff across all Canadian goods when he takes office here. This could materially impact ADF's operations as it ships fabricated steel products to the U.S. from its Canadian facility. Now, management believes that potential steel tariffs will likely focus on raw imported steel rather than fabricated steel imports. So that's something that's good to note. And even Ryan mentioned that in the introduction of the podcast as well, just to make sure that we're pointing that out. But, there does remain risk that potential steel tariffs could materially impact the business. And in the near term, management is seeing some downward pressure on pricing and slower project decision making as clients wait for more clarity. So in the near term, the business does not need capital for, expanding capacity, and will likely focus on paying down debt and returning capital to shareholders, which is great. And, all in all, my long rambling here, there is an investment case for ADF as it possesses a healthy balance sheet. Backlog remains elevated and the business remains relatively cheap in relation to its earnings and adjusted EBITDA. However, risk is heightened in the face of near-term, tariff uncertainties, as well as tough comparable margins the business will need to lap in fiscal year 2026, and the risk of potentially investing in the later stages of what management has called, an atypical cycle. And as such, we continue to monitor. And then I'll also just show the disclosure here that we do not hold positions in the stock.
Yeah, I think it's a really good summary. We put together a good report. I think management, when we interviewed them, they were competent.
Hmm.
I think it's a
Agreed.
pretty well run business, but it is a cyclical business. And, we did talk to the company, about their contracts going forward. And, you want to monitor that backlog. Are they going to have to take on, some lesser margin businesses? Because, the margins are not where they have been historically.
Yeah.
So there's the risk that you even come through with relatively similar revenues, but at lower margins, or lesser revenues and same margins, then it's going to be hard for them to have growth on the bottom line
Yeah.
over the course of the next year. It looks like it's relatively cheap, but then you look back at a historic PE on the company, and it always trades at a discount because of the cyclicality of the industry. Perhaps we have a longer term cycle there that continues, but I always hear it's different this time, and it doesn't tend to be different this time. So you've got to take, not from management that I'm saying, but you got to look at it in the light of a company that has been cyclical long term, and those things typically don't change over the long term. So we would just monitor the business at this point, despite the fact that if you compared it to a market PE, it looks cheap.
Yeah.
But is it, in terms of a company that has a significant amount of cyclicality and is trading with inflated margins, really?
Hmm.
Or like, these are high margins for a business like this, and this business, if you look at it historically.
Yeah, exactly. Like, and if we look, I did have it up on the screen, but if we look back, at the last 11 years, 2015, 2018, 2019, 2020, all negative net income margins, in
Mhm.
those years. Even just, 2016 and 2017, it was marginal net income margins of, 2%. So all of a sudden, in the last 9 months, we're sitting at 18%. Obviously some of that automation has helped,
Yeah,
as management
and
indicated, and I noted,
yeah,
but,
then there is the potential to sustain a higher level of
mhm,
margins over the long term, and we're not saying it's going to go back to significant
yeah,
negative margins, but you've seen a tremendously good environment for the
yeah,
company. Does that continue going forward? Well, for you to grow earnings next year, like we will have to, and I'll bring that back to, we do see businesses. You have a finite amount of capital that you can invest. If you can find a business that does look like it has growth next year, has a good balance sheet, trades at a reasonable price, that's what we're looking for. This company checks off a lot of those boxes.
yeah,
We're not looking at EPS growth from our estimations this
mhm,
year. And if we don't see that, we'll just sit on the sidelines and wait till we are projecting growth, or we see management projecting earnings growth going forward, because that's going to drive the stock ultimately. Even if it looks cheap now, you
yeah.
want to have growth in the business, and that's why we have a GARP approach. If you don't have the G in GARP, you have ARP, and I'm not sure what that is. That doesn't make sense to me.
Nice.
So we're going for GARP, not ARP.